not enough working capital in the business. And often this results in surprises for the business owner. They run into surprises around cash needed to pay their suppliers and their business expenses, primary one, payroll. Sometimes lack of planning results in a tax bill that they weren't expecting. And so these surprises cause a lot of stress for our business owners. Fast growth is another major reason for challenges with cash flow. Now, fast growth is exciting and it is a good thing, but it can stress your cash flow. Cash gets tied up in inventory required to support that fast growth, and it's in your customer's hands in terms of your accounts receivable. And so a large order or a big customer is very exciting for a business. That can be both a blessing and a curse, right? So some of these big customers can be someone like Walmart. A lot of businesses, they strive to get Walmart or other large customers. Some local ones could be even like Hy-Vee or Fleet Farm. You know, if you land that account, that's going to be awesome and really support your sales and growth plans. But it can also put a lot of pressure on your business. Like you get this large order, you may not have the resources really to buy the inventory that you need for that. You might outstrip your line of credit with your bank, or you may be able to kind of put together the resources to take care of this big order, but now your existing customers, you can't take care of them. So fast growth can be a challenge for cash flow. Profit margin deterioration is another challenging place. And this is where either discounts on your pricing or increases in cost. And we've seen this increase in costs, you know, recently, definitely seeing some inflation creep in. And there's some imbalances coming out of the pandemic between demand and supply, you know, for product and inventory. There's delays in the supply cycle, and these things are causing price increases, and that can cause profit margin deterioration. Business owners have to be careful and strategic about the right time to pass along those price increases, you know, to their customers. A few other areas that can cause negative cash flow is not managing your credit or understanding the credit worthiness of your customers. Basically, when you give someone the chance to pay you later, you're becoming a banker and loaning them money. And so you want to make sure that you're loaning money to credit-worthy customers. So you need to have a good process, you know, to really understand the credit worthiness of your customers. If you allow customers too long to pay, of course, that's going to strain your cash flow because you need to pay your vendors and you need to pay your employees. So that's how you get out of sync with your working capital. Some business owners commingle personal and business expenses, and that can make it difficult to really understand your business and may disrupt your cash flow if you're putting too much expense, personal expense, into your business. And then unexpected events can cause problems. Again, they're unexpected, you don't realize it. So it's good to have a little bit of a cash buffer to help take care of those unexpected events. And that again was a hard lesson learned as we went through the pandemic. Many companies really didn't have much of a buffer, and when there was a slowdown in their customers, then it really had an impact. Okay, so here are the top 5 ways to improve cash flow. And we'll go over these real quick, and then we'll go into some detail on each of them. So number 1, implement a cash flow forecast and a budget. And this really will enable you to know where you stand in terms of cash flow and to do some better planning or react to changes in your environment. And shortening collection times, so managing your accounts receivable and then actively managing your accounts payable. Those are the 2 levers that you really can control to improve your cash flow. And then decrease or eliminate slow-moving inventory. Managing your inventory that's a key cost in terms of your business and has a huge impact on your cash flow. And then finally, strengthening your banking relationship. That's critical to have a great relationship with your banker, and that can really help you really be in a better position prior to needing more money. And we'll talk more about that at the end. But managing that banking relationship is key to your cash flow. All right, so we're going to tick off with implementing a cash flow forecast. So business owners, they must have a solid cash flow forecast. And you need this whether you're growing or struggling, or if you're in a strong cash position or under stress. You definitely need to have a good cash flow forecast. And we want this so there's no surprises for the business owner. You can also use a good forecast to help you secure bank financing before you need it. And then the best practice is really to have a 13-week cash flow forecast. And the forecast you'll have a good understanding of all your cash receipts or what's coming in and cash expenditures. And when you have a good understanding of your cash flow for the next quarter, for the next 3 months, you're just in a much better position to manage your business and to work with your banker on your cash needs. So here's the steps around the cash flow forecast. It's actually fairly simple in concept, but it does take a fair amount of work and discipline to do. And what you're going to want to do is estimate your cash receipts and your cash expenditures for the next 3 months. And so on the receipt side, primarily your sales is going to drive your cash coming in. And what you want to do is understand when you sell something to a customer, can you get cash deposits, a certain amount % paid up front, and then the rest will go into accounts receivable. And then managing that accounts receivable is going to be key. But in terms of your cash flow forecast, you want to look at your aging reports. So your accounts receivable aging reports, that's key to understanding the timing of when your customers are going to pay you, based on the terms that you've given them and where are they kind of in that pattern of paying you. You may get some interest income if you have some interest-bearing accounts, whether those are CDs or other shorter-term investments that you may park some money in. And then you need to understand your seasonal patterns. Some companies sell more going into the holiday season, or some companies may do more business during the summer, particularly if they're a construction or landscape, type companies. So understanding the patterns of when revenue is coming in will help you with your forecast. And your cash expenditures, of course, the biggest one for most companies is going to be payroll and payroll-related taxes. Also, you need to plan for income taxes, and you should be putting estimates together quarterly around your tax obligations. Inventory is another huge cash need or expenditure for companies that are resellers. And then you have other sales and marketing expenses, your other general expenses, rent, interest that you may have on loans, loan and lease payments, distributions to owners, so money that you want to take out of the business. And then it's a good idea to have a cushion in there for unforeseen expenses. So once you know all of that, you can put together that cash flow forecast, and that'll put you in a better position to plan and pivot your business. Not only is a forecast important, but a budget is very important. And you should put together a budget every year, have an annual planning and budgeting process, and you're going to put together, your planned revenue and expenditures for the next year. But you want to break that down by month. So you actually will have a monthly budget, and that budget, going through that budgeting process may reveal some shortfalls or concerns that you have, and may make you think a little bit more about your business plan or how you make money. Do you need some more or diversified customers? Should you bring on some additional products or services to sell? So this budgeting process can really help you fine tune your business. Ultimately, you'll have a monthly budget, and through the year, you want to compare that 13-week forecast that you put together against that monthly budget and see how things are working out. Are they better or worse than what you had planned for? Is there new information that you're discovering through your 13-week forecast process? Take a look at that, determine drivers of variance, and then develop action plans to pivot and improve your business and keep your cash flow positive. All right, now we're going to focus on managing your account receivables, and it's really all about shortening your collection times. So when you bring on a new customer, make sure you communicate upfront what your credit terms are. Make sure they have a good understanding, set expectations with them. If possible, get deposits, get them to pay you some cash upfront. And then make sure your invoices are accurate. You want to fix errors promptly. It's best not to have any errors. Errors cause delays, right? If you send out a bad invoice and your customer lets you know, hey, this isn't right, this is not what I expected, you need to fix this. So it takes some time to, work through that, get a new invoice out there. Now your days have just been extended again. It can also make your client or your customers grumpy. If you have errors, they can lose some confidence in you and they may start looking around for other services. So making sure your invoices are accurate and timely is very important. So managing your collections, that means bill promptly. You want to collect that money as soon as possible. So once you've secured the deal, get that invoice out quickly but accurately, and then aggressively follow up on anything that's overdue. Make sure you follow up and have a process to get after those collections. It's important to understand the longer your account goes uncollected, the less likely you are to receive the full amount. So actively managing your receivables aging report is key. Make sure you know where your customers stand. And then back to the comment about understanding the credit worthiness of your customers. Make sure you assess that credit early, as a new client. Do a background check, collect as much information as you can about them, like who are they, who are the owners, where is their business. The more information you have about them, the easier it is going to be to collect money from them. A couple other topics around shortening the collection time is give discounts for paying early. Accept payments from credit cards, Apple Pay, Google Pay, PayPal. If you offer those, you will get money right away, right? Those become the lenders and the credit cards, or you can get kind of direct payment either from PayPal that either comes from their checking account or from their credit card, but you get the cash right away. Now, certainly there are some fees for that, but the idea is you pay a fee or you offer a discount to collect money sooner. Those are good strategies to get cash into your company faster. There are some other technologies like Square or VisiPay that make the payment processing faster and easier, both for the customer and for you. So I'd recommend looking into those if that you don't already use them. And then nurture your best customers, and some deserve some special terms. Some of your best customers that either buy a lot with you or pay, very well, they may need some extensions from time to time. I definitely think you should be flexible in working with them, but be specific and be conscientious about it. If you have looser credit terms, it would certainly allow more people to be available to buy your products and services. You may sell more, but if your credit's too loose, you won't collect as much and you will have bad debt or uncollected, revenue. So you need to manage that carefully. Again, be very conscientious about who you lend money to, and then have some measures around your sales versus bad debt. And if you're increasing sales quite a bit, manage that bad debt, make sure that bad debt's not getting out of hand, with that increased sales. Now I'd like to talk about some working capital solutions, ways to help you with your working capital. So lines of credit are issued by bankers, and having that great relationship with a bank will help you get a line of credit that will help you with your cash flow. If a business is kind of established and is in good shape, is stable, slower growth, they won't have any trouble getting a line of credit from the bank. If the business owner has good to excellent credit and is well-heeled or in a good financial position, the banks will be happy to give you a line of credit, often unsecured. and with a very low interest rate. Kind of the next step up from there would be a secured line of credit. And secured would mean it would be, have some collateral or an asset tied to it. Most common would be your accounts receivable. So my abbreviation there, AR. I'm sure most all of you know what I mean by that. So your AR and or your inventory could be the collateral for a secured line of credit, or a AR financing is really a secured line of credit. They offer you some money in advance or cash in advance based on your accounts receivable. That's a good option for a growing company. I mentioned the line of credit. The bankers are more comfortable with more stable, more established company. Well, many companies are newer, and there's a lot of new companies coming out of the pandemic, and they're doing very well. They're growing very fast, and they need help with their cash flow. Banks aren't necessarily comfortable with that. They're more conservative. It takes time to underwrite. They have to talk about it. They have loan committees, all these things that kind of slow down you getting your cash. So AR financing, AR factoring can be some solutions there. And so with AR financing, basically your accounts receivable or AR is the collateral on a loan. So it's a loan. You as a business owner still own your account receivable asset, and you're still going to collect, make the collections on that receivable. The finance company would upfront give you cash for probably 80, maybe 90% of the accounts receivable upfront, and then you'll collect the remaining amount and pay a fee to the finance company. And that cost is going to be higher than an interest rate than you would on a line of credit, but is a very good solution for many fast-growing companies. Kind of the next way to get some cash into your company is with AR factoring. The difference there is you actually are selling your account receivable to the factoring company, and the factoring company will collect that accounts receivable. And they might loan you maybe up to 80%, might be somewhere between 70 and 80%. The amount you get depends a lot on your credit worthiness as a business, but I doubt they would do more than 80%. But you'd get 80% cash up front. That'll help you cash flow your business. Can be a huge help. The factoring company will actually collect the accounts receivable, and they'll pay you the remaining amount less their fee when the AR is paid. And then there's a cool concept called reverse factoring. This is a really good situation if you get into a relationship with a new customer that's a big customer. So they're big, you're smaller. They want to help you become a supplier for them. They will introduce the factoring. It's still an AR factoring. You're basically going to get cash up front on the money that business owes you. It's kind of like going back to that Walmart or maybe Hy-Vee situation. You're a new vendor or supplier to them. They're going to help you get financing to buy your inventory. And because they're helping you get the financing, really the asset is the money that they owe you. And since it's a big company like Walmart or Hy-Vee, they're very credit worthy. And so the factoring company, they know they're going to get paid. So the interest rate is actually a little bit better than what you would probably get working with a factoring company directly. So that's a neat solution. Can be a good solution for a fast growing company that is partnering up with a bigger buyer. And then I recently found out about a platform that's out there. It's actually been out there for a while, but it's growing. It's called C2FO. They're a technology company based out of Kansas City. And they basically have a platform that brings sellers and buyers, or suppliers and buyers, together in a platform. And you can negotiate getting cash for your receivables through that platform, mostly through discounts to the pricing. But that would be something I'd recommend that you research a little bit more. And I saw some articles on this recently where Walmart is partnering up with C2FO to help diverse suppliers better cash flow and become more viable suppliers for Walmart. I know that Costco and Albertsons have used them for a while. And then I saw another article where Goldman Sachs is partnering with C2FO through a subsidiary of Goldman Sachs called Marcus, which helps, it's a finance company that helps small businesses with working capital. So I wanted to share that with you guys, some newer information that I just found out about that I think is pretty exciting. Could be some good solutions for fast-growing companies that need capital. All right, now we're going to talk about actively managing your accounts payable. So this is another key area of improving your cash flow. So understanding who your vendors are, develop a vendor payment schedule, know which vendors you need to pay first, and you need to make some decisions around paying quickly or not paying quickly. Obviously, the overarching theme here is to pay as slow as you can. On this side of things, account payable, you want to have them loan money a long time. Most of the time, though, they want their money fast as well, and so it's kind of a balance. So don't pay bills early unless you're taking advantage of favorable terms. So you can get a discount on pricing if you pay earlier. If that makes sense for you, then you should do it. So in this case, the terms were 2% 10 or net 30. You'd get a 2% discount if you paid within 10 days, or you pay full price as long as you pay within 30 days. But don't pay late. If you don't pay on time, you're going to incur late fees and interest charges, and you're going to instill ill will or bad feelings between you and your vendor, and that's not good. If you can pay faster than industry practice, that can buy some goodwill and loyalty with your vendor, and you may need that later. And so, in the example where you've brought on a bigger customer and you need to buy a lot more than what you've been buying, and you could talk to your vendor if you're in good terms and you've been, paying either early or just a good solid payer. You can try to negotiate extended terms in this situation. And oftentimes they're happy to work with you on that because they're excited that you're going to have a bigger customer and buy more things from them. So the key on this is to be in good standing, do a good job in terms of managing your accounts payable. And when something comes up, have really good communication so you can work through a solution together. All right, managing your inventory. For businesses that have a lot of inventory, this is critical to your cash flow. Really understanding your inventory, what sells well, what's not selling as good as it used to. What are your profit margins by product? Very important to know these things. And so really assessing your inventory turnover, how fast are things moving? Do you have any obsolete inventory? Has the market changed on you and you have things that used to sell that's not selling anymore? You just need to get rid of that and see if you can sell it to people other than your customers. And so there's some auctions that you could do that with. You could even do it on e-auction. You see Marketplace on Facebook, a lot of people are selling things on there that they don't need anymore. So there's ways to get rid of it, but the idea is just convert that obsolete inventory into cash or just get rid of it. And then make sure you have a really good purchasing department or a purchasing person. That purchasing manager can make or break your company depending on how good at of sourcing your inventory at competitive prices, sourcing inventory that's going to move quickly, and sourcing inventory that you have strong profit margins on. Investing in the right technology to help you track and understand your inventory, I think, is a good investment for most businesses, and really having real-time understanding of where your inventory stands and those profit metrics around that can really help you lean into selling the products that are most profitable and or selling to customers that are most profitable, and moving away from product lines that aren't as profitable. There can be situations where you have a product that's not that profitable, but it's tied in or related to a very profitable product. And that's good to understand, as well. You may need to carry that product that's not as profitable in order to sell more of the product that is very profitable. So good analysis around your inventory is just key. And there's been some different perceptions or concepts on this. I think prior to the pandemic, we definitely had an emphasis on having very low inventory and having a just-in-time inventory mindset, meaning working with your suppliers that when a customer makes an order, you get the inventory in and you're not carrying very much cash or using very much cash in your inventory, which is a very good theory and it works well when there's not disruption in the market. But we learned some things in the pandemic that, supply chains can get compromised or complicated. And then we didn't have inventory available for customers. And then that's one of the reasons why we have, some of these pricing pressures is that people are scrambling around for demand on low inventory items, and that's causing pricing, to go up. So, it might mean that having a little bit more of a buffer in your inventory, might make sense. Those are, individual decisions for businesses, but something to think about. All right, now we'll talk about strengthening the bank relationship. And a lot of times business owners have a love-hate relationship with their banker. They feel like many business owners feel like the banker doesn't really understand them or their business. And so my advice is to think of your banker like you think of your customers. Business owners spend a lot of time learning about customers and thinking about markets and what solutions can the business owner bring to the market in order to have either product or services that people want to buy. Well, think about your banker the same way. What does your banker want? Figure out what they want and then give them what they want. And, bankers, what they want are customers that have businesses that are going in the right direction, have timely and accurate financial statements, have a strong management team, and can really tell the story about where the business is going. So I think the best thing to do is be prepared for discussions with your banker and talk to your banker often. Keep them updated on your plans for growth. Have timely and accurate financial statements, have timely tax returns with a reputable CPA, know your business key performance metrics or indicators, and know your lending ratios. Know the language of the banker so that they know that what they're looking for. Provide projections and assumptions about where the business is going. And this will put you in a position to talk with the banker before you need that increased line of credit. Let your banker know your plans for growth and that you are seeking more and larger customers. And when that happens, you're going to need a higher line of credit. So kind of prime that pump before it happens. Let them know your plans, get them ready. Bankers do not like to be surprised. What often happens is a business owner lands a new client and they're very excited and they put a deal together and they don't quite realize the implications to their cash flow until they're kind of surprised themselves. And then they go run into the banker, hey, good news, I got a new client, I need more money. But the banker is not going to give you money right away. It takes time to go through the process with the banker. So my key point on here is take the time to cultivate your banking relationship. And an established relationship will be able to provide you with solutions to help you obtain financing and help you with your cash flow, with increased line of credits or other financing solutions. So those are the top 5 ways to improve cash flow. And I think we're ready to open it up for some questions.
Great, thanks, Eric. If you guys want to turn your cameras on now, we can feel free to have a group discussion. There is a question in the chat box, Eric. The question is about invoicing change orders on a large term projects where 50% is due up front and 50% due at the end, or a 10% discount when paid in advance. We often do a multiple change orders over that time. I've been billing these at the end of the month and asking for payment upon receipt. Is there a better way to do this? Sometimes these are harder to collect on.
Yeah, I think what you're talking about is you have a lot of change orders in your relationship, and so the invoice, changes. A little bit of that's the nature of your business. It is complicated, but having really good processes around invoicing is what's going to be key on this, and communication. Communication is also key. In terms of I like the fact that you have 50% down. At least you have most of your money or half of it right up front. But things are going to change over time, and just being real prompt on that. There are some vendors and some tools that can help you manage your invoicing, and so that might be an option, is to get some help in terms of some automation around invoicing, or just the processing of the invoicing might be a solution that could help you.
Yeah, I was wondering, just in that scenario, I have another client and they do 50% upfront too, on the project, and then they bill usually monthly for that last piece. So if the 50% is due and there's 5 months left, they bill the 10% accordingly, and then they usually add on if there's additional mileage or expenses or scope creep where they've now had a change order. That's how they do it. I don't know if that's would be an option for Mackenzie at all, but I think that's another way potentially. But yeah, I agree, those are hard, and clients love to just tack things on and creep on their scope without wanting to pay for it. So that's always a hard thing.
Yeah, but that's why I said it always goes back to communication, right? You have to be clear on, here's the invoice, here's the updated invoice, you asked for this additional work, and so here's your updated amount. And stay on top of them. Don't let them linger.
I've had a client actually even just this week, Eric, that talked about, the invoice they sent out was due within 30 days. And it states clearly that if it's paid past 30 days, that there is an interest fee on there, and their client refused to pay it. What is the procedure for pushing back on that?
Yeah, I think you have to be aggressive in terms of going after your money. And customers that don't pay on time, they're not going to be good long-term customers. And I think that's the balance. I think if there's a reason that they're late and you want to work with them, I think it's good to have that discussion. But I don't have a lot of tolerance for customers that just aren't paying you. If they've got the means or the resources, they're just delaying it. They're trying to work if everyone's trying to manage their cash flow from their perspective, right? But what we want to work with good partners, both on, we want to be a good partner to our suppliers, and we want to have good partners on our customers. So I would recommend be firm and go after your money.
Okay.
It's owed to you. You earned it.
Yeah, they basically said that they paid the invoice late. They knew that there was going to be the interest rate, but they still deducted the interest off of there, which, again, I was like, I don't know that this is a real client that you want to have to fight to be paid.
You don't want to be chasing them around. So you need to consider that the next time they come to buy, right? Is that someone else that, that's why it's key to have a diversified client base. I work with a lot of business owners that have very few customers, and some of those customers are awesome. They're very proud. Hey, I work with, Hy-Vee, but they've only got 5 customers. If one of those customers changes their mind, their business is in serious risk. Mm-hmm. So I like to celebrate those big customers, but let's go get 3 more big customers. Mm-hmm. Right? Let's go that way. When you lose one customer, it's not quite so painful.
Yeah, or that one, you only have 5 customers and that one customer is not paying you and it's taking your cash flow for the rest of them. I see that happen too. It's okay. Yeah. I tell people every year you should fire a certain percentage of your clients. It's a live and learn lesson, and find out who you want to work with and work with those people and get rid of get rid of the rest, or find that, hey, here's a better solution for you. We do have another question, Eric. How often would you remind clients to pay back the invoices?
Yeah, so depending on your terms, you've given them a certain amount of time. Let's just say it's net 30. If they haven't paid you after 30 days, I would follow up weekly. I would start pestering them. I'd have a way in place to say, hey, you're overdue. Be real nice about it on the first time, right? And then if another week goes by, then remind them. And then, call them. I would talk to them if you can, or have, someone within your organization that's responsible to help you on collections. Because the longer it takes, the longer they don't pay you, the less likely they're going to, and they might get comfortable. Not, they get comfortable owing you money. You want them to be uncomfortable owing you money. Right. You want to let them know you don't like it, you don't appreciate it, it's not right, it's not what we agreed to. Please pay me right away.
Eric, you've mentioned a couple, working with bigger clients. We currently are working on a supplier diversity session for small businesses. Background on terms when working with a bigger business, what's normally expected? Any advice on working with a bigger business as we move some of our small businesses into considering that?
Yeah, I think one of the things you have to understand is that big business has the leverage, and they're going to ask for longer. Like, they're not going to pay you for 90 days or 120 days, which is terrible for the small business owner. Right. Puts them in a really bad position. And so that's where some of these other solutions come to bear, like factoring or reverse factoring. That would be something I would think about if I'm a supplier trying to get to these bigger companies. What's their relationships with this reverse factoring or this C to CFO or C to CFO, that new vendor that I talked about? A lot of the big companies are on that platform, and it can help a smaller supplier cash flow much better. So I think that's the thing about going into those relationships is you need to understand they're going to try to extend the terms, look for ways to get that cash earlier. The other part is let your vendors know, your suppliers know about, hey, I'm trying to get into this bigger relationship, and they're likely going to want extended terms. Can I get extended terms with you? So the people you're buying from, get them into that kind of that ecosystem around, hey, I'm starting to work with this big customer, and the terms might be a little bit different. Can you help us come up with a solution?
We're working right now. Actually, it's happening right now at the same time, but we are actually working with the corporate side too. So we're actually doing supplier diversity and training the corporate buyers. And that's been something we've been talking to them heavily about, is that we know you've set these goals to work with small businesses, but trying to educate them as well. So hopefully we can kind of get everybody on the same platform, speaking the same language for that piece, because a lot of times the small businesses really want the account, but it just doesn't make sense to their cash flow. And I'm sure you have seen that happen. Let's leverage too much.
Yeah.
All right. Yeah. Other questions from the group? We've got a good group on today. And I know there's a ton of different industries on here as well. Well, if we don't have other questions, Eric, if you don't mind dropping your contact information down in the chat. So if they want to send you a private message, they have your contact information. And while you're working on that, I will briefly discuss. We have the top 5 for small business coming up next month. It's September 22nd, and it will feature top 5 insights to success from an entrepreneur. And this is actually a really interesting story because he went from a 500 credit score to an actually growing a $10 million business. So he's had quite the wild ride. It has really built a successful business. So we're really excited to hear his tips and tricks for growing his business. And then I do want to mention too, I will drop in that link actually to top 5, but I do want to mention that our Small Business Success Summit, we have actually selected the final speakers, and the announcement will be coming out very quickly on who our speakers are that have selected. The committee had such a tough job this year selecting those, but it will be in person on November 5th. at the FFA Center in Ankeny, and registration is open for that if you would like to go ahead and register. But really excited about the lineup of speakers this year, and we'll have the website updated with all the speakers, all the information, and sessions here within the next couple weeks. So I will drop that link in as well. But any parting words, Eric, that you want to leave us with this morning?
Well, first, I'd like to thank you, Christina, for this opportunity and the Greater Des Moines Partnership. All the great work that you do to help small business owners. I think it's awesome. I just love it. And I want to thank everyone for participating today. I appreciate you viewing and listening and asking your questions. And if there's any way that I can help you or connect you with resources, I'd be delighted to do that. Please don't hesitate to reach out.
All right. Thanks everybody for joining. And one final thing I failed to mention is if you'd like to join us tonight on our startup tours, we're actually speaking about the entertainment industry at XBK tonight at 4:30. Feel free to drop in and join us. And there is a free concert afterwards. So if you'd like to network and mingle with some other entrepreneurs and learn about entertainment as a small business, feel free to join us there. Thanks for joining today, guys. We'll see you soon.